In this video, we will be making a bull and a bear case for Ethena. We will cover what Ethena is and how the protocol works. We will learn that Ethena has one of the biggest total addressable markets out there. We will also talk about the valuation. Is ENA the token over or undervalued? And last but not least, we'll look into the tokenomics and protocol risks so that you have the full picture at the end of this video about Ethena. Let's go. All right, if you open the app, you can see that Ethena is essentially a dollar savings product. It pays you out on average 5% API on your stablecoins. And how exactly does that earnings product work? So the user is coming with some stablecoins or whatever as he prefers and wants to have a yield on them. And he's putting $100 in Ethena in this example. And Ethena in the background converts that $100 into Ethereum. That was the original product. And then the Ethena is going to stake that Ethereum into Lido. And then at the same time, shorts $100 worth of Ethereum on a centralized or decentralized perpetual futures exchange, which leads to a stable $100 worth in value. And this is represented in a token which is called USDE. You can now either stake and earn 5% on this $100, like it says here in the app above, or you can use the $100 as you please. For example, deploy them into various DeFi protocols. Since its original idea, Ethena has diversified its yield sources. So the $100 don't necessarily get deployed. The Ethereum strategy of buying Ethereum, staking Ethereum, and then shorting it on a perpetual futures exchange is not the only way anymore. Ethena generates yields on these stablecoins. But for example, there are stable strategies which presumably involve crypto lending protocols like Aave and Morpho. But the main strategy is the partnership between Ethena and BlackRock's Build fund, which essentially is a money market fund and is represented in a token which is called USDTB. And this money market fund generates a stable yield as well, mainly with short-term treasuries. And also Ethena has expanded its collateral strategy. So it's not using only Ethereum anymore to back the USDE collateral as the only crypto asset, but also Bitcoin. So the question here is, how's the USDE rate, staking rate 5%? Where is this 5% coming from? And there are three main sources of yield here. The first one is ETH staking. So that part of the collateral backing of USDE, which is staked Ethereum, earns 2 to 3% yield. And the next source of yield are funding rates. Remember, in the workflow, I said that Ethena is going to buy Ethereum, stake this Ethereum, and then short the $100 worth of Ethereum on a perpetual futures exchange. So it gets a stable dollar value. Funding rates are periodic payments exchanged between long and short traders in perpetual future contracts to keep the contract price aligned with the underlying spot price. When the funding rate is positive, longs pay shorts. When it's negative, shorts pay longs. And since the overall market bias is positive most of the time, Ethena is getting paid for its short position it takes on Bitcoin and Ethereum. And then lastly, I already mentioned the BlackRock's tokenized money market fund Build. That consists of mostly of short-term cash yielding instruments like T-bills. And it yields roughly 4% at the moment. Let's have a quick look how Ethena allocated or weighted the different collateral types. So first of all, some basic stats. We have roughly in circulation today 6.5 billion USDE, the stablecoin. The market capitalization of Ethena, the project, or the ENA token, is $3.5 billion. And you can see the exact collateral breakdown here on the bottom left, roughly 65% are in liquid stable tokens and the USDB money market fund, and 35% are still collateralized by mainly Bitcoin and Ethereum as collateral and take on this short positions as I explained before. The reason why Ethena has most of its stable coins in liquid stables and the money market fund is that it mitigates the risk of Ethena being exposed to longer term negative funding rates. Most of the time it gets paid to take on these short positions, but it could also happen that Ethena has to pay the long positions, and that would negatively affect the yield of USDE. And the 65% money market fund allocation stabilizes the yield and creates a natural yield for the USDE savings rate. And now we come to the market opportunity, and this is really huge and one of the reasons I'm talking about Ethena, because a dollar yielding stablecoin or yield on your dollars is really one of the most demanded projects out there. As you can see here, $18.6 trillion sit in US bank deposits. Money markets have $7.7 trillion worth of value. And the overall global fixed income market on dollars is $145 trillion big. So huge opportunity here, especially if we consider that we are only at $6.5 billion in USDE in supply. Now, there is a restriction for Ethena protocol. The open interest is the total number of outstanding active unsettled perpetual futures contracts in the market at a given time. Ethena does not want to grow their share of open interest over 25%. So right now they have 4% of all open interest in the Bitcoin and Ethereum perpetual futures market. So that's roughly 6x from here. And a realistic target would be getting to a $30 to $50 billion USDE supply within the next 1 to 2 years. All right, what's the growth strategy of Ethena to get to 30 plus billion USDE supply? First of all, yield bearing collateral. Ethena's USDE is integrated as collateral in various perpetual futures exchanges. This lets traders earn the staking rate while trading. And noticeable partners here are Binance, Bybit, MXC, but also Hyperliquid. And that, of course, increases the demand for especially the stake version of the USDE stablecoin. Then, in my view, the most promising product, stablecoins as a service. Ethena provides its stablecoin infrastructure for other financial players like fintechs and banks. These clients brand the product as if it was their own. For example, in Revolut, they could implement a stablecoin which is called RevUSD and offer the same savings rate for their customers. The higher savings rate will attract more capital to their platform, in this case to Revolut's platform. And Ethena can charge their protocol fees or maybe even an additional service fee. And they already have partners for the initial launch, which is Jupiter, the Sui blockchain, and also the Mega ETH layer 2. And then lastly, we have Converge. Converge is an institutional blockchain which is created with the goal to bridge TradFi to DeFi. The product was supposed to launch in the second quarter of 2025, and I haven't found any updates since, so they might have abandoned this project. So it doesn't seem as promising. One more note for the stablecoins as a service product. For example, the Jupiter integration of this product brought in an additional 500 million of USDE supply, and there we can really see the potential of the stablecoin as a service product. Then one extra thing to mention, which is not really related to the growth strategy, but it is noteworthy to explain in order to make a bull case for the ENA token. Ethena has its own digital asset treasury company. The digital asset treasury company is called Stablecoin X, and it has the mission to increase its ENA holdings per share. And as of right now, they're roughly holding 20% of the total ENA supply, which is worth 700 million at a market capitalization of 3.5 billion. And what is the investment hypothesis in this digital asset treasury company? Well, traditional finance is pretty convinced by now that stablecoin growth is going to happen over the next couple of years. But how can you bet financially? How can you profit financially from this trend of stablecoin growth? Well, traditional finance is used to go to the stock market and pick stocks that represent that trend. But the problem is there are not that many publicly traded companies that represent that truly represent the trend of growing stablecoin supply. And the most famous stock we can think of is Circle here. Circle has a market capitalization of 18 billion. So the thinking here is stablecoin X, the digital asset treasury of Ethena, could represent another pure stablecoin play in the traditional stock market that is not yet as overvalued as Circle is right now at 18 billion, since you can buy stablecoin X at a significant discount even to its underlying assets at 73.6 million market capitalization. And with this, you could expose yourself to the trend of stablecoin growth. So how do we value the protocol and specifically the ENA token? Let's look at the past 12 months revenue from 2025. The total amount of revenue the protocol brought in was $384.6 million. The fully diluted valuation is 3.5 billion. And the net revenue of that, because 80% of this revenue is going to staked USDE holders. 20% is going to the treasury right now. And in the future, potentially 10% of this 20% here will go to ENA token holders. And that I will consider as earnings. So essentially, the earnings will be 10% of the $384.6 million that the company or the protocol has made over the last 12 months, which would lead at a $3.5 billion valuation to roughly a 100x price to earnings. And if we even take only the month of December and annualize the earnings, then it would even be higher at 147 price to earnings multiple. Now, how can we make possibly a bull case out of these high multiples? Well, crypto is a very cyclical industry. Let's assume here that the Federal Reserve in the United States will cut rates over the next 2 years. Then people will feel like they're not earning enough on their dollar savings, so they will go further out on the risk curve and buy risk assets. Risk assets pump, therefore, and Bitcoin and Ethereum are mostly considered risk assets. That will lead to higher funding rates because people want to participate in the trend and go mostly leveraged long these assets, Bitcoin and Ethereum. Therefore, the protocol revenue of Ethena would go up because they're profiting off of higher positive funding rates. And that will make the stake USDE version making more yield, while the rates for short-term treasury bills are going down. So the spread here becomes wider and wider. And therefore, more and more dollars go from traditional savings vehicles into Ethena protocol. And the more USDE are in the protocol, the more revenue will the protocol make overall. That would make the ENA price go up. If the ENA price goes up, probably the stock price of stablecoin X will go up as well because they're holding ENA. And if they even would trade at a premium, then they would be able to raise more capital or to issue more debt to buy even more ENA from the open market and therefore further reduce the ENA supply. So we have increasing revenues then, but less and less ENA is available on the market, which should lead to an increase in ENA price. So that was a very abstract scenario. Let's put specific numbers and assumptions behind this bull case scenario. So let's say the Fed funds rate is going down from now roughly 3.5% to 2%. The funding rates for Bitcoin and Ethereum will go up to roughly 12.5%. And the USDE supply will grow from $6.5 billion to $35 billion. The allocation, the collateral allocation behind USDE will stay roughly the same. We have 33% of the collateral in the basis rate at 12.5%, and 2/3 will be still in a BlackRock money market fund at 2% yield. That will give us a blended earn rate of 6.5%. So the protocol will earn 6.5% on its TVL, which is $35 billion. And this would decrease the multiples price to revenue ratio of 1.5x, a price to revenue net ratio of 7.6. Those are the 20%. 10% are going to the treasury, 10% are going to the token holders. And if you only consider the revenue that is going to token holders, which I originally considered as earnings here, that would reduce the price to earnings ratio from 100 today to 15.2x. And then we are only at 2% Fed funds rate. If the narrative at this point will be that rates are going to reduce even further, and therefore Ethena might even receive a way higher price to earnings multiple, for example 45, and that would 3x the token value. So let's talk about the tokenomics real quick, and we will start with the token allocation. The ticker is ENA, the max supply is 15 billion. Then we have a circulating supply of roughly 50% today. The token distribution is as follows: 30% is going to core contributors, 25% is going to investors, 30% goes to ecosystem and airdrops, and 15% is going to the foundation, which is a fairly normal token distribution, I would say. Now, a very important part here when it comes to unlock pressure. So in 2026, the token supply will grow from 53%, where we are at today, to 73% of fully diluted valuation, which is at the current fully diluted valuation of 3.5 billion, roughly 700 million in potential sell pressure that will enter the market in 2026. And in 2027, it will be even worse with 756 million in potential sell pressure. It will taper off in 2028, where we will eventually reach close to 100% circulating supply. So the big takeaway here over the next 2 years, 1.4 billion of sell pressure is coming into the market at a fully diluted valuation of 3.5 billion, where we at with the ENA price today. So what is the ENA utility? And Kaido made a really good flow chart here, which explains really well the value flow of the protocol. So this part I already explained. We have staked asset rewards, this staked Ethereum, then the perp funding spread. The protocol is making money by collecting positive funding rates, and the liquid stable rewards. 80% of that is going to staked USDE holders because they will want to have their savings rate competitive. Right now, 20% of protocol earnings are going into the treasury, but most likely this will be cut in half. 10% will be going to the treasury, and 10% of that will go to staked ENA holders in the future. The products here, which I also talked about before, the stablecoins as a service, then DeFi and CeFi integrations, like, for example, yield-bearing collateral on exchanges, or Hyena, which is Ethena's own perpetual futures exchange built on top of Hyperliquid, and other Web2 expansions will increase TVL and revenue of this part here, and therefore USDE holders should get higher rates, and staked ENA holders should get higher dividends. Then we have the lower part here. I already talked about Converge, the institutional blockchain. Converge will do an airdrop to staked ENA holders, as will other ecosystem apps that are building on top of Ethena. So every protocol that will be launching on Ethena is going to allocate 15% of its airdrop to staked ENA holders. Then I also talked about the digital asset treasury company, Stablecoin X, which will do ENA buybacks. In addition, staked ENA holders can participate in governance and will get various ecosystem incentives, mostly the airdrops, but there could also be other ones. All right, what are the risks here for Ethena? First of all, we have a counterparty risk. Essentially, you are trusting the Ethena team on the execution. For example, on a rapid market upturn, Ethena shorts might get liquidated because remember, they're buying Ethereum and Bitcoin with 2/3 roughly of the collateral in the background and then shorting it on a centralized exchange in order to keep the value of USDE stable. These shorts might get liquidated on a rapid market upturn when then the market falls all of a sudden or turns around and goes into a negative direction before the Ethena team was able to reopen its short positions, the value of the collateral is at danger to fall below the outstanding USDE supply. So that's a real risk. And of course, you're trusting also the custody of funds. Ethena does not take custody of the funds itself, but trust various custodians. So you as a user have to trust these custodians as well. Then we have the competition risk. We talked about yield-bearing collateral. Various centralized exchanges already built their own yield-bearing collateral version to trade on perpetual futures. So users are probably less likely to use the staked USDE version as yield-bearing collateral. Then an Ethena competitor could also emerge that is going more risk on because Ethena has a majority risk off strategy where they hold 2/3 of their collateral in the BlackRock Build Fund, which helps has a really good yield floor. But in especially in bull markets, projects that go more risk on could be more interesting to people because they're getting higher yields. And also all of the lending markets will in crypto like Aave and Morpho will benefit from a sustained bull market as well because people are generally more willing to borrow stable coins. So lending markets become natural competitors for Ethena as well. Then we have the regulatory pressure. Ethena is officially approved in the US, but for example, the EU did not accept the USDE stablecoin in the MiCA framework, and other jurisdictions might restrict their access to USDE as well in order to protect their own currency, for example. And then we have smart contract risk, of course, if there's any bug in the smart contract and hackers will be able to exploit the mint and redeem contract and therefore mint an infinite amount of USDE or even an amount that is higher than the backing collateral. That is could trigger a bank run, or at least the project will bear a lot of financial damage. And there could be also, of course, Oracle manipulations as well. Then we have two additional risks under low liquidity conditions. USDE might temporarily lose its peg. That could lead to the market panicking, and therefore there could be a temporary sell of USDE below its peg. And the staked Ethereum that Ethena is holding as collateral could lose its fair conversion rate because staked Ethereum is not equal to Ethereum. There's also a conversion rate on the open market in relation to Ethereum. So after talking about the tokenomic and the risk, we can also make our bear case here for ENA the token and Ethena the protocol. Let's imagine there won't be any crypto euphoria over the next years. If there's no euphoria and funding rates stay low in crypto, then the USDE rate as a savings rate won't be as attractive. Therefore, not as many users will likely take on the extra risk and buy the staked USDE or allocate a capital into the SUSDE product. Then the EU restrictions might spread to other jurisdictions that will forbid the access to USDE. The protocol revenue will stagnate, and then we have these $1.4 billion unlocks at a 100 price to earnings multiple that will make the price bleed for sure, especially if there aren't any big market movements over the next couple of years. All right, so what's our conclusion here? Ethena is a very promising project. As we have seen, they have a huge market to serve, but they're also an extremely cyclical product. There are good arguments for a bear and a bull case. It really all depends on what thinks the broader market outlook is going to be over the next 2 years, and if the stablecoin as a service product is going to be a success, since most people will never touch crypto protocols directly. And that's it with my Ethena protocol analysis. Which case do you think is more likely, the bull or the bear case? Let me know in the comments below. Also, I write on Substack. If you want to have these analysis before my videos come out, I will drop the link of my Substack in the description below. And that's it for the video. Thanks for listening and see you on the next one. Bye bye.